Okay, let's dive right into this. Welcome to The Explainer. Today, we are going to master the entire Fundamentals of Partnership chapter in one single shot. Seriously, if you're looking for clear concepts and zero fluff, you are absolutely in the right place. Now, you might be sitting there a bit worried about the basics of partnership accounts for your Class 12 exams. And hey, I totally get it. It can feel incredibly overwhelming when you're staring down this massive mountain of accounting rules. But look, today, we're going to turn these seemingly dry, boring rules into a logical, easy-to-understand game. No more confusion, just a clear playbook.
So here is our roadmap for today. First, we'll cover the rules of partnership. Second, splitting the profits. Third, calculating your interests. Fourth, tracking partner capital. And finally, fixing mistakes and guarantees.
All right, let's kick things off with Section 1, the rules of partnership, defining the players. So what are we actually talking about here? A partnership is, simply put, a relationship between two or more persons who agree to share the profits of a business. Before we can even start playing this game, we need to know exactly who is at the table and what our core objective is. Now, what's really interesting about this concept is the specific terminology we've got to use. The individuals involved, we call them partners. But when we refer to them collectively as a single business unit, they form what's known as a firm.
And of course, literally any multiplayer game has player limits, right? A partnership is no different. You need a minimum of 2 partners to even get started, but you can't just invite everyone you've ever met. The maximum limit is strictly capped at 50 partners. Now, normally, partners will agree on the rules of their specific game through an oral or written agreement, and a written one is called a partnership deed. But what if they don't? What if they just forget and the deed is completely silent? Well, that's when the Partnership Act of 1932 kicks in with its strict default settings. If there's no deed, profits are shared equally, period. There's no interest on capital, no interest on drawings, and absolutely no salary or commission for any partner, regardless of how many late nights they worked that year. Pretty harsh, right? So the crucial point to remember here is this number, 6. If a partner provides an actual loan to the firm, and we're talking separate from their capital contribution here, and there's no partnership deed dictating the terms, the default interest rate on that loan is exactly 6% per annum. Examiners literally love testing this specific scenario, so for sure, lock that 6% into your memory. Okay, moving right along to Section 2, splitting the profits, keeping score. To actually distribute those winnings, we use a specific ledger called the Profit and Loss Appropriation Account. It's kind of like a giant bucket. On the addition side, which is the total money we have available to distribute, we start with our net profit from the business, plus any interest on drawings we've charged the partners. Then, on the deduction side, we subtract out the rewards we're giving the partners. So interest on capital, salary, commission, and any money we strategically decide to tuck away as a transfer to reserves. What's left over at the very bottom? That is your divisible profit, which finally gets split up according to the partner's profit-sharing ratio. Which brings us to Section 3, calculating your interests, the math. Okay, I know this is where the heavy calculations come in, and it can definitely feel a bit intimidating. But stick with me here because we're going to break it down really simply. First up is interest on capital. You can think of this as rewarding a player for the financial investment they've made into the game. It's calculated strictly based on 2 things, the capital contribution amount and time. You only get interest for the exact amount of time your money was actually sitting there, actively working in the business. And this brilliantly illustrates the flip side of things, interest on drawings. This is when the firm actually charges a partner for taking money out. Now, there are 4 specific methods to calculate this, depending on how messy or scattered those withdrawals are. Number 1, the average period method. This relies on a standard table and is your absolute go-to if specific dates aren't given. Number 2 is the simple method. Number 3, the product method, which is fantastic for scattered, uneven withdrawals. And finally, number 4, the formula approach. If you master these 4 specific methods, you will literally never be caught off guard by a complex exam scenario. Let's jump into Section 4, tracking partner capital player stats. Just like tracking individual player stats in a video game, we need a highly reliable system to monitor each partner's score, or in this case, their capital balances over time. We have 2 options here. Under the fixed capital system, you maintain 2 separate accounts for every single partner. A main capital account that stays mostly untouched, and a current account where all the day-to-day adjustments like interest and drawings actually happen. Alternatively, under the fluctuating capital system, absolutely everything is just lumped together into one single capital account. Now, here's a pro tip.
If an exam question remains totally silent on which system to use, you must always, always default to the fluctuating capital system. Finally, we've reached Section 5, Fixing Mistakes and Guarantees, Addressing Glitches.
So what actually happens when a rule is completely forgotten or a specific promise is broken in our game? Because, let's be real, businesses make mistakes. Maybe they just forgot to record interest on capital last year. We obviously don't want to rip up the old financial statements and start the whole game over from scratch. Instead, we use what's called past adjustments. It's a super clean, logical 3-step fix. Step 1, you identify the omitted item. Step 2, you figure out who accidentally got too much money and debit the gaining partner. And Step 3, you credit the losing partner. The whole shebang gets solved with just a single, elegant adjustment entry. And lastly, we have the guarantee of profit. You can honestly think of this as a special cheat code for a specific player. It essentially ensures a minimum profit amount for a partner, no matter how badly the firm performs overall. But wait, that money doesn't just magically appear out of thin air. If a shortfall occurs, the guarantor partner, the one who actually made the promise in the first place, has to reach into their own personal profit share to make up the difference. Well, that brings us to the end of our explainer, but I want to leave you with a question. To avoid those super strict default settings we talked about, what rules would you write into your own partnership deed? Mastering these fundamentals for your exams is really just step 1. I challenge you to take these concepts into the real world. I mean, if you were setting up a firm tomorrow, how would you structure it to protect yourself and reward your partners fairly? Keep practicing these concepts to boost that confidence, and I'll see you in the next explainer.